Imagine earning weekly extra income on your stock holdings even if the stock itself doesn't go up. By the end of this video, you're going to know everything you need to fundamentally know to start selling call options to make weekly income with your stock portfolio. And all you're going to need to do this is a stock portfolio with as little as $500 inside of it. I've been using this strategy on and off for about 5 years, and I truly believe it is one of the best strategies with the least amount of risk. So this video is going to be perfect for people looking to get a little bit extra return on their stock portfolio without adding too much risk. How exactly are we going to do this? Well, we are going to be selling covered calls. But what exactly is a covered call? Well, let me explain. In simple terms, a covered call is a stock option strategy used by stockholders to earn extra income on their stocks. So let's break down the basic components of how the covered call works. First, we're going to start with the stock ownership. And the first key to selling covered calls is actually owning 100 shares of the company you are going to sell options on. This might sound like a lot, but like I just mentioned, $500, there are some stocks that we can trade on that only trade for $5 a piece. You must own the shares of the underlying in order to sell a contract against it. Options are sold in contracts of 100 shares, so one option contract has the weight of 100 actual shares. Then breaking into a little bit more of the call option part for the buyer, this gives the buyer the right, but not the obligation, to purchase the stocks at a strike price by a given date. So how does the covered call work? Suppose you own 100 shares of Ford. Ford is currently trading at just about $10, so you own $1,000 total in Ford, and you decide you want to sell a contract to a buyer for a strike price of $10.50 that expires 2 weeks from now. So in order for the buyer to actually have the right but not the obligation to exercise this contract, they have to pay you a premium. And this premium can vary a lot, but let's say they give you a premium of $1 per share. And this $1 per share times 100, hence 100 shares in a contract, will equal $100 in premium that you get up front. And this is money that you are guaranteed even if the option is exercised. And it is this premium that is exactly how we are going to make this weekly income. Once this contract has been made and you are in it with a buyer, then there are two possible outcomes for how this could go. Option one is that the stock price does not go above the strike price. The outcome here is that the option expires absolutely worthless and you walk away with your weekly income. Option two is that the stock price actually goes above the strike price. And in this situation, you may get exercised, which means your 100 shares are called away for whatever that strike price was. In this example, $10.50 a share. But when you think about it, this is actually not so bad because you are locking in and guaranteeing profit on top of the premium you are already paid. So with that simple example, I hope you understand exactly how you can make a decent amount of passive income every single week doing this strategy. Covered calls are a great way to generate passive income, specifically in a neutral to slightly bullish market. With that example out of the way, let's actually hop right over to my Robinhood portfolio so we can start working through it step by step. Okay, so as you can see, we have my Robinhood portfolio pulled up. If you're looking to get started on Robinhood, feel free to use the link in my description, but this strategy will work on any brokerage platform account you have as long as you have level 2 options enabled. And for those of you who are using Robinhood, let's quickly look at how to enable them. It takes no time at all. You're simply going to click on your profile, go to that little 3 hamburger icon, go to investing, and then you're going to scroll down until you see options trading. As you can see, I am already at level 2, but if you are not, you simply go into option settings and you are going to click this upgrade button at the top. You may be asked to complete a couple forms, a couple Q&A thing. Overall, it takes absolutely no time at all to do, and it is very simple. So with level 2 options enabled, we now have to find a stock that we want to trade on. Some of you may already have 100 shares of a company you're looking for, but for those of you who don't, we are going to walk through it as if you are completely new to this strategy. So the first thing you're going to want to do is click on the icon up here to browse, the little magnifying glass, and then we're actually going to use a stock screener so that you guys can really hone in on exactly the stocks that are best for this strategy. So you're going to add a filter, and for me, I put in just over $1,000 to work with. So I can buy up to any company that's just about $10.80 trading right now. But if you have a portfolio of say $500, like I mentioned earlier, you are going to go to the screener and you're going to go to share price. you would do under $5, and as you can see, there are over 250 results, and you would simply scroll through and choose one that you liked the most. But we're actually gonna get a little more advanced with it so you guys can find stocks that are objectively better value for selling coverage calls for weekly income. So I'm going to adjust the share price to under 20 since they don't have quite an under 10, but we're also going to go in here and we're going to scroll down, and you're gonna wanna look for either highest option volume or options availability. I'm going to look for the highest options volume. I'm going to increase that just a little bit so that we're filtering out some that have very low options volume. Going to show that, and if we want to take it even a little bit further, we could actually look at the implied volatility, which brings up a point that I think is very important for this. Implied volatility means how much the stock is expected to move during a given period. A general rule is that the higher volatility, the higher premium you will get paid for a time period. So if a company has an implied volatility of 20% versus 100%, you will get paid much more for the company that has the higher IV or implied volatility of the 100% company than the 20% company over the same exact time period. Obviously, with that comes the inverse side, that there is a higher chance that your shares would get called away, meaning that the share price went above the strike price you set in this contract. But yeah, we're just going to raise it to about probably 33%, just a little bit of volatility so we can kind of get it going. And I had a company prepared beforehand. I actually want to trade on Rivian because this is a company I've been looking at. I see their cars a lot more on the road, and it's a company that I actually want to own because I think they have something to say in the electric vehicle space. And that is another important thing for covered calls, is that you are owning the underlying of 100 shares of a company. So it is best if you choose a company that, for whatever your personal reasons being, you actually do like them for some reason. You're not simply just playing it for weekly income, which is still a fine, viable strategy, but you're more likely to hold that company. And keep in mind, the stock can go down as well. And so you don't want to hold on to a stock that you think is pretty trash, but has good implied volatility. But for this case, we're going to go with Rivian. So we're going with Rivian. We're going to click the buy, and we're going to purchase in shares. We're going to buy 100 shares of Rivian at, okay, so as you can see, we have 100 shares. I put a limit price at $10.65 per share, or a total estimated cost of $1,065. And as you can see, our order was just completed. We now have our 100 shares set to go, locked and loaded. And now we are actually going to navigate to the Rivian page. We're going to click trade, and we're going to want to click trade options. So you're going to be built with this option strategy builder, but we are not going to be looking at that. We are going to be looking at these different time horizons that we are given up here at the top. You're going to want to navigate to the sell call function of the options builder. And as you can see, it is currently 2 days before these contracts close. So you see, we're not going to get much at all. So we are going to look at the October 18th contract that is currently just a little bit over a week from today. And as you can see, if we go into this, you're going to see a lot of different things. You're going to see the implied volatility that I was talking about earlier. It's pretty high. And so as a result, we're going to get paid roughly $32 to $34, which is just about 3% return in a week on our shares, which is great stuff. But as you can see, our chance to profit is 72.93%, which that is a little bit misleading at times. That's not just factoring in, like, are you going to get called away versus not? It factors in share price and things like that. It's better to look at the delta, which actually means the likelihood in terms of a decimal that it will get called away. And as you can see, this is about a 40% chance that it will hit the $11 strike price. We're going to click sell on this, and as you can see, we can sell one contract because we have 100 shares. And then I'm going to put the limit price, and as the seller, you are going to be putting out the ask. And the ask and the bid essentially means what people will buy it for and what people will sell it for. So the ask is what the seller is willing to sell it for, and the bid is the highest price that the buyer is willing to buy it for. If you have taken any economics classes, it's supply and demand. It is not a super difficult concept, but as you can see, it's putting up our estimated minimum credit as $32.97 because Robinhood takes a 3-cent fee on every contract. And then of course our collateral, which is if the contract does not go our way, what will be pulled away is our 100 Rivian shares for $11 a share, which would net us actually a profit of just about $40. And then if we add in the credit that we're getting from this options contract, we would be at about a 7% profit in just 1 week, which is incredible considering the stock market normally returns only 8 to 10% over an entire 52-week period. Okay, and as you can see, our contract just sold for $32, so $1 less, but really not a huge deal. And so when you're at this point, now you don't have to do anything. You have made your money, and what you can do from here, if you really want to watch it and you don't want your shares pulled away, you can wait a couple days for the contract price, this contract price, which is currently trading at 33 cents, to go lower, and you can actually buy the contract back to secure profit and your shares. So for example of what I mean, let's say this current price of 33 cents dropped to 20 cents. You could buy that contract back with the premium you were paid, and you locked in that $13 of profit, and your collateral is now back to you, so you keep your 100 shares. So there are a lot of different strategies for actually inside of the covered call area to how far out should you sell and things like that. And this video is not intended to be a video like that. It was just meant to be an informational, instructional video on how to sell covered calls for weekly passive income. Covered calls are a great strategy for the investors who are a little more conservative, who want a little taste of options, but they like to own the underlying, and they're just trying to get a little bit more leverage and insurance in the event that their stocks are called away. So for this example specifically, if I were to do this every single week and get a reliable premium of just about $30 or just about 3% of the entire price of my shares, I would be making over $1,500 a year in extra income that you could then use to reinvest or spend or do whatever you want with it. That's your money. And for those of you who have more money that you want to do this strategy with, it multiplies. And those of you who have less, it is still a viable strategy if you can find the right stock. And I'm not here to give the stock recommendations. You are going to need to find that yourself. The example I used today was just for my own personal use and purely informational for you. You can easily see how 3% returns a week could really help build your portfolio and create returns that are absolutely abnormal in a market environment. Covered calls are a great option strategy that you guys should definitely learn some more about. There are plenty of free tutorials online. You don't need to buy a course to figure out how to effectively do it. It is simply not necessary. Don't let anyone tell you that it is. Before trying this on your own, make sure to do a little more research on the risk, because this was a very baseline video, but I hope it was enough to get you interested in the power of the stock market and specifically options inside of the stock market. If you're interested in learning about other ways that you can also make passive income by selling options in the market, make sure to click on this video right here where I give you another great strategy that does not require you to own any shares. Let me know in the comments if you tried this strategy, how did it go for you, if you're going to try it, what stocks are you looking at for that? Overall, I'm just curious to know what you guys are gonna do with this strategy. Make sure to subscribe and like this video if you like money. That's all I've got. Thanks, y'all.